TheoTRADE. This is Don Kaufman. It's September 20th, 2024. Just about an hour to go to the cash close here on this Friday afternoon. And look, it's not just any Friday afternoon. Oh no, it's the triple witching expiration, which quite frankly has not meant much this Friday. I mean, a little bit of volatility hitting the marketplace. When you start looking at the S&P futures, done like 1.1 million contracts, but yeah, there's an hour left to go. But I got to tell you, there are some really interesting things to discuss in this marketplace. And I'm going to tell you right now that this triple witching expiration, it absolutely matters. And I want to explain that and much more here in just a moment. Before I get there, though, look, the Fed. Of course, everybody throughout the course of the week is going to be discussing the Fed. This weekend, they're going to be thinking about the Fed. My opinion right off the bat is that the FOMC just put bulls on notice. So I'm going to explain that and much more here in this TheoTRADE weekend update. Let's jump right into it with just a brief discussion of kind of like the bullish mojo and the triple witch and why that kind of matters. For that, I'm going to cruise over to the SPX, the mother of all products. By the way, you know, a lot of people don't understand why I call it the mother of all products. Well, I'm going to go to the SPX and I'm going to cruise over here on Thinkorswim to the trade tab under today's option statistics, just to start off with a kind of a quick point over here of why I look at the SPX so much. Today, the SPX, okay, thus far has traded about 2.5 million contracts. Now, timeout. Just give you an example. Yesterday, the whole marketplace did 58 million contracts. So we would agree that, you know, the SPX gets it done out there. And then if you look at the spiders, guys, the spiders, they're good for about 7 million contracts. Just the two of those put together, you're going to do over 10 million contracts. Okay. So you have to kind of think, you're like, well, all right, you're doing like 20%, close to 20% of the volume in the entire options market is just spiders and SPX. And you know, obviously we can pull up a couple other products, but here's the thing that people miss is the SPX is a $5,700 product. You know, it's like 10 times the size of the SPY. So you look at, 2.5 million contracts, but think about the notional value going through that. That just basically means, like, if you actually worked out what each one of those contracts, you averaged out the deltas and everything, each one of those contracts is actually worth. And quite simply put, it's phenomenally large. It's incredible. So this expiration, okay, and why I'm going to talk about why the triple witch matters and you know, the bullish mojo of the marketplace. This expiration is said to have about $5 trillion worth of options expiring. And a huge amount of that obviously went off this morning, the AM settlement in the SPX. So I'll come back to that thought in just a moment. About $5 trillion. Now, before I get there, okay, we've had our little bit of a bullish mojo back onto the marketplace, starting like last week. All right, there was some big sell side activity 3 weeks ago. Huge bid back onto the market last week. We popped through the upper edge of the expected move. This week, okay, you did absolutely nothing Monday, Tuesday, even Wednesday, even after the FOMC. But on Thursday, we woke up into an, well, proverbial crap fest to the upside, hit the upper edge of the expected move, and here we are today. Look, this is, you know, S&P is moving 21. That's massively unchanged. So there is your bullish kind of mojo. All right. Now, why does that relate to this triple witch? Well, when you are trading for a trading firm, your Citadel, your Virtue, you're one of some of the big market making firms. Look, the big market making firms are predominantly trying to maintain a degree, if you will, of delta neutrality. And a lot of people are not aware of that. In fact, if you're actually labeled as too big to fail, they have to use what's termed bona fide hedging activity, which basically implies that the delta, which is the directional risk incurred, should be relatively neutral. So to do that, and I'll just give you an example. if a market making firm, okay, sells calls, okay, if they sell calls, um, that would actually produce negative delta. They would turn around and immediately offset that with positive delta, okay, to kind of zero out the position. You're like, well, who's buying the calls? Could be a retail trader. Lots of retail traders buy calls. Market making firm, and this is the market making firm, okay, sells you the calls, and they have negative delta. They offset that with positive delta, and they do it instantaneously. But then if the market starts to actually rally a little bit higher, okay, it gets out of balance and they have to go out there, okay, and mitigate because these calls keep going in deeper in the money, right? And those calls, they could start off as a 50 delta. All the calls go to 60 delta, like rah raggy, and they have to go out and buy a little bit more positive delta, buy some more stock. And when you buy more stock, the marketplace goes up and it goes up and it goes up, and you start to actually get locked into, okay, this feedback loop, okay. And you're in a positive feedback loop because the more you buy, the more you have to buy. And the more that your competitor buys, you have to buy. Why? Because you're all trying to maintain delta neutrality. And it's often what you term like, the gamma squeeze. Okay, my gamma hurts. So you're getting into this a little bit of a gamma squeeze. We start to explode to the upside. And the amount of risk and, given an expiration is just phenomenal. It's huge. It's like a $5 trillion amount, right? Well, guess what? On a triple witch, you're basically pulling the plug, okay, on the ball of risk. So if you've been in this like kind of positive feedback loop and it starts to, it's just a mass, all of a sudden that ball is gone. It's gone. What happened to it? It expired. And that can actually really free us up. I'm not saying that we can't go higher from here. We absolutely can go from higher here. We can go right back into the positive feedback loop. But there's this brief, momentary lapse of reason, okay, where ultimately you don't have, okay, that magnitude of risk pushing us higher anymore. Why? Because it literally expires. So we can come into Monday and markets could be a little bit more free flowing. And we'll actually find out on Monday. It's kind of an interesting synopsis that a lot of retail traders, they never really thought of that before. They've just never thought of it because that's not the way that you're taught, like, but the MACD and the Fibonacci, none of that matters, okay? None of it matters when you're in a feedback loop. And you're in a feedback loop right now, and that feedback loop can get ripped apart by the triple witch because stuff expires out there. Now, this morning, a huge amount of the SPX already came off the books. Okay, we haven't exactly backed off very much, right? I don't care if futures are down right now. They're down nominally. That's the upper edge of the expected move on that chart. So it is what it is, but we'll see because that bullish mojo can actually meet its maker here real quick. Next thing I wanted to look at is, if you're not aware, skew hit the all-time high. That was last night. It's the highest print ever of skew, which basically implies just the whole world is hedging right now, which makes it makes a lot of sense. Because there's election risk, and that's what's coming next. Like the high skew, all right, high skew, when people are like, don't make more of it than it is absolutely, it's record breaking, and the skew is the out of the money put implied volatility versus out of the money call implied volatility, and it is huge by huge. Okay, so the skew is absolutely there. Those out of the money puts are trading for a huge premium versus out of the money calls. Just the the differential between those two. Okay, the VVIX though, VVIX volatility, the volatility index has come off, but not that much. I think that the VVIX has probably found a home north of 90. Okay, for the next few months. And why do I think that? Because again, we're kind of already seeing volatility election backwardation. What I mean by that is the volatility futures. Okay, volatility futures are actually in a very mild backwardation. If you actually look at No versus Dice, okay, we're in backwardation, which is you're like, oh, that's crazy. No, but it actually makes perfect sense. Okay, what doesn't make a lot of sense is that the October volatility is also really, really high. The OCC vol is above no vol. And you're like, wait, well, that doesn't make that much sense because the election's actually coming in, of course, in November. And I know, and this is something you better pay attention to right now because I just hit upon, as I said, I got some cool stuff to show you here in this weekend's update. And one of them is like vols in backwardation. And I get why no vol is fairly high, but there's a crap load of risk here in the next 26 days is what the marketplace is basically implying. More risk in the next 26 days, okay, than there is, even into the November and December volatility situation, and it is a situation in there. So I wanted to bring that to your attention first and foremost. And again, you can surmise anything you want out of here, and you're like, well, why is the bulls on notice? We're going to get there in just a moment. But I did want to display to you, okay, you got a super high skew, which means clearly people are still hedging out there, right? Then you've actually got volatility and backwardation, which makes sense because there's an election, but it doesn't make that much sense because the ACK vol is sky high. Then let's move on to the Fed. Okay, let's state the obvious. The Fed cut by 50 basis points. I got to tell you, last weekend I was like, they're cutting 25. Like, there's no question. All of a sudden, there was a question. And then all of a sudden, they cut by 50. Okay. By the way, I'm as surprised as a lot of people possibly were. Of course, there's always ones in the crowd who are like, no, okay, no, you knew they were going to cut 50. Really, I didn't. I didn't think they would go to 50 because I think it's actually an incredibly gutsy move. And I'm going to explain exactly why right now it is such a gutsy move. Like, look, you can look at this tape all you want. As I said, we're in kind of a bullish feedback loop right now, right? Okay. The financials ready. It looks like they're ready and primed to break out to the upside over here. You can examine every stock till you're blue in the face. Okay. Apple, which you've even been hearing that Apple, maybe its sales are not going so well of the new iPhone. Doesn't matter. Why? Bullish feedback loop. There's no fundamentals behind this. Meta, are they really doing that well? No, they actually broke out to the upside. They got above this like 540 level, exploded to the upside. It's everywhere you look. It's everywhere you look. Don't think too hard about technicals. Okay, don't think too hard about technicals. Don't think too hard about fundamentals. You worry about crap like gamma risk right now, okay? And you definitely should be worried about the fact that the skew is elevated and the ACK vol is so high. You should be worried about that. And that the triple witch could actually break this marketplace loose. Now, I'm not trying to bear up on you, but here is where I'm going to start to bear up on you, okay? Here's where I'm going to start to bear up on you a little bit. Come into FedEx. Talk of the trading community right now, because now people are nervous because the Fed just cut by 50 basis points, which everybody is aware. Okay, look, that's old news. But FedEx, that's a little bit newer news because they're like, well, it's not going to be that good. Like, this is joining a growing list. And you can't avoid listening to it anymore because there's some pretty prime time companies that are like, oh, maybe they're not doing that well. But the marketplace doesn't care because the marketplace isn't dependent upon FedEx. The marketplace right now is, I like NVIDIA. Okay. Oh, as long as Meta goes up, we're going to be fine because the S&P 500 is owned by tech. Doesn't matter what you think. It's owned by tech. Apple, they could absolutely suck. Doesn't matter. Caught up in that bullish kind of, mojo over there of the, the gamma squeeze over here. But you got to be careful now because you're hearing warnings. Okay. FedEx, one that also was on my radar screen was Darden Restaurants. Now this thing traded higher, but their earnings, they sucked. They didn't really provide forward guidance. Okay. But it was bad. It was really bad. So you're like, why is it higher? They cut a deal. Okay. They're going to deliver, whatever it is they do over there. Olive Garden to your home. The point of going to Olive Garden because it's not your home because you can get like 500 breadsticks. Okay. Anyway, moving along over there. So I got questions when I start looking at stuff like FedEx because immediately, and this is the next point over here is going to be the critical one. You start looking at FedEx. By the way, FedEx, is it a big move? All right, it's down like $41, $42 right now. It is a big move. Why? Because it was expecting a $21 move. So it's 2 deviation move. So it's on. Like that thing got smoked. Why does FedEx matter? Like, why should this even make my list? One underlying, yeah, but it's a growing list of like Dollar Tree and Dollar General. Like if you haven't been looking at this, okay, with CEOs screaming, okay, that they're getting absolutely annihilated on the retail side, and now FedEx joins the list over there, it's concerning. Normally I wouldn't pay attention to it, but you just had the Fed cut 50 basis points, which brings me to another really critical point. Data dump. Oh boy, data dumps are really going to matter. So move forward to next week. When I talk about data dumps, I'm talking about even the most benign data dump, okay? Which would be, for instance, jobless claims, which comes out every single week. People are going to care. Durable goods, oh, are you kidding? They're going to be all over it, Okay, why? One's durable goods. Are you kidding? Everything. Because if anything is looking like it's going to slow down, the Fed's already cut 50 basis points. Okay, the Fed just shot a huge warning flare up in the air and told you it's not a warning flare. Okay, they just shot it up in the air, boom, it's up there, 50 basis points. Okay, and then they said, no, we're recalibrating. It's recalibration, just like transitory. It's recalibration, though, at this point. You got durable goods. Okay. The end of the week over here is going to get, it's on. Like, there's like, GDP, PCE data. This is actually a huge one because this is, PCE data that's the biggest and baddest of them all. That's what the Fed actually looks like. Nobody gives a crap, right? Until they do. Wholesale inventories, like, holy crap. Like if any of these, okay, show, for instance, like inflation coming back, okay, you're in trouble because they're 50 basis point cut. If they show inflation coming back, the Fed was wrong. If they show that data is weak, then the Fed knew something and didn't tell us. You see, we're in a huge catch-22 over here. Data needs to be real consistent, or like consumer sentiment. What if consumer sentiment comes in a little bit weak? Oh my, it's going to get ridiculous. Data, which mattered a lot, now is going to matter the most because data dumps, all right, are going to, well, they're going to confirm or deny what the Fed has said. Think about that for a second. Economy's strong, but we're cutting rates by 50 basis points. All right, enough of that. Let's actually move forward to one of the more important points that we make each and every week here at TheoTRADE. That's the expected move. Once again, in this week of trade, expected move is spot on, people. It's spot on. Look at what is, people were looking at the move on Thursday and they're like, it is completely ridiculous. It's an unrelenting move right to a line that we drew, okay, on the screen last Friday. Is that what you're telling me? Nobody else knew that was coming. Of course we knew it was coming. We had it on the screen. Okay. It's 57.27. Okay. And we literally hit it spot on. Hit it spot on, reverberated off of it, just a little bit below. By the way, just because the line's on the screen doesn't mean we have to close there. All it basically is saying is, hey, that's what the marketplace is anticipating us to move. And people, it's exactly what we did. On Wednesday night's video, I told you verbatim, you're moving 100 points higher, 100 points lower, so strap in. That morning, 100 points higher on the button. Okay, pay attention. Because next week is going to get even more interesting. So look 7 days out with me. Knock down the number of strikes. This is alarming to me because the expected move next week is only $78. Now, I know we had a Fed meeting this week and yada, 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 but you just saw over 100 points of movement in one trading session. And now they're telling me that all of next week is only a $78 move. And that may even diminish a little bit. Depends. There's still almost an hour left in the trading session, right? So, look, you got to keep your head in the game because what's two major factors in here. Number one, the triple witching could just kind of shake us loose, meaning that it loosened up, some of that gamma that had us in that positive feedback loop. That's one critical aspect, right? That positive feedback loop could come to a crashing end. Again, I reiterate, there's upside potential in this marketplace, but the downside risks are even larger. And that's the summation of here, right? So you could have, as I said, that upside gamma risk, okay, kind of get released. But I'm much more concerned about data dumps. I'm much more concerned as we start to, even turn the corner and start to look into earnings again. If you have data that is not consistent with what the FOMC, okay, just told us, because they may have been trying to sell you a bag of goods. You're turning the corner into an election season, okay? You got to be careful. Be on your game. Those data dumps can rock this marketplace, and it's going to reverberate for days, even weeks to come. All right, that's it here, of course, on this TheoTRADE kind of weekend update, coming out of a week with $100 expected move. We got every bit of it. Again, real nervous, looking forward to this one. $78 of movement being implied with a lot ahead of us in this next week of trade. Thanks, everybody, for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.